In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about SEBI's new rules regarding algorithmic trading and what it really means for people like you and me as investors and for people who track the markets. And in the second story of the day, I'll talk about a quick update on Donald Trump's tariffs that he has been imposing on China, Canada, and Mexico. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to our traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 6th of February. Let's begin with the first story. Look, SEBI has recently released a final set of rules for algorithmic trading, which is often also shortened to algo trading very popularly. Now, algo trading, for your reference, is when computer programs automatically place buy and sell orders for stocks or other securities. A trader basically sets up rules or conditions in the program, and whenever those conditions are met, trades go through instantly without the person having to click any buttons whatsoever. Until now, most of the market's algo trading came in from large institutions or high-frequency trading firms, and it accounted for around 70% of the total trading volume. Recently though, many smaller traders got interested in algo trading as well, thanks to easy access to online platforms and broker APIs or application programming interfaces. Now, for your reference again, APIs are ways for traders to connect their own software to a broker system so trades can be sent without having to manually enter them at all. Now, this growing popularity brought some concerns because some unregulated platforms started making unrealistic promises about huge returns. SEBI first released a consultation paper in the month of December which focused on stopping this kind of unregulated activity altogether. It also aimed to protect ordinary people who might want to experiment with algo trading but didn't quite have access to reliable information. The final framework that SEBI has now introduced is very similar to what was proposed in that December paper. The main goal is to strike a balance between allowing more retail participation in algo trading and maintaining trust in the market. Under these new guidelines, SEBI has officially recognized the use of APIs for retail algo trading. This means that traders who like to build their own automated scripts or algorithms can do so in a clearly defined manner rather than working in a gray area. However, there will be stronger security measures. For example, brokers have to restrict each API to a specific client's account and ensure that logins are protected by multiple checks like OAuth and two-factor authentication. Now, these requirements basically help people from accidentally letting someone else trade on their account or from falling for scams where a fraudulent strategy is plugged into their APIs. SEBI has also decided that algo platforms which offer ready-made strategies for traders to use should be recognized in a more structured way now. The exchanges will now review and monitor these platforms, and brokers must do background checks before bringing them on board. Not all algorithms are treated the same though. Low frequency or simpler algorithms which do not send out huge bursts of orders every second can operate without too many formalities. But on the other hand, if an algorithm is capable of placing a very large number of orders in a short time, it falls under stricter rules because it can affect the market more significantly. Now, for your reference, algo strategies offered by platforms are split into two broad categories. The first type is called a white box or execution algos. Now, these are strategies where the logic is visible and the users know exactly how trades get triggered. And because everything is out in the open here, they don't really need the same level of scrutiny or approval, and SEBI wants to fast track their registration so that people can use them without unnecessary delays. Now, the second type is called a black box algo, where the underlying calculations are hidden. Now, these are often used by professional traders or institutions. And since the strategy is proprietary here and the user cannot really see the logic, there is a higher risk involved. SEBI now requires that providers of these black box algos be registered as research analysts. They must keep research reports on how their algorithms work, and if the algo changes in a big way, they have to inform the exchange and go through reapproval. Now, all of these changes, of course, will not happen overnight. Detailed standards on how everything should work will be decided by April 1st, 2025, and the actual rules will only be enforced starting 1st August 2025. Now, if you are a regular retail trader who wants to take a dip in algo trading just to try it out, this means that the path is now much more clearer for you. You will very clearly know if you're dealing with an unofficially recognized algo or if someone is just making wild promises to you. You will also know that your broker is operating under very strict guidelines for security and monitoring, which will help you stay away from platforms that promise quick riches without any proof. And if you do see any platform making over-the-top claims, you can be sure that the exchanges and regulators will be keeping a close eye on them. Now, on the other hand, for larger institutional players, not too much changes here, except that they too will be under stronger oversight to ensure that everything is above board. But broadly speaking, the main story here is that what once used to be a gray area where brokers provided APIs or platforms and people built their own scripts without clear regulatory acceptance now has official recognition. SEBI wants to make algo trading safer, more transparent, and still keep it accessible to traders who have the know-how or the curiosity to try automating their strategies. This is also a sign that algo trading is increasingly becoming a part of everyday investing rather than something reserved only for the largest firms now. With that, let's move on to the second story of the day. Look, a couple of days ago, we had touched upon Donald Trump's tariffs on China, Canada, and Mexico. But now there is a small update on this front. These tariffs against China and Mexico specifically have been paused for 1 month. So in other words, the United States have given these two neighboring countries a 1-month break and said that it would not apply new tariffs right away. Canada and Mexico in return of this have agreed to be a little more stricter about border security and drug enforcement and are now almost racing to strike a deal with the US. But on the other hand, China was not really given any such pause. China instead decided to fight back by imposing tariffs of its own on American goods, especially those from the energy and automotive sectors. China is also planning to challenge America's move at the World Trade Organization, which is the main global body that tries to regulate international trade. But that's not really the topic of discussion today. See, what makes this situation so significant and important is just how large and sudden America's tariff increase is. See, before Trump had taken office, all tariffs on American imports taken on average added up to around 2.4%. Almost overnight though, this has jumped to about 10.5%. And that is one of the biggest tariff spikes in a century of American history. And to give you an even clearer picture of this new round of tariffs is 5 times bigger than the total amount that Trump imposed during his entire first administration. So this in many ways is a substantial jump that could pretty much reshape trade patterns around the globe. Now the question you might be asking is, why exactly is this so worrying? See, let me tell you that there are immediate concerns of inflation because goods become more expensive and there are possible job losses if firms can no longer afford certain materials or find competitive markets for their products. But even beyond these short-term issues lies a bigger problem. Sudden changes in trade policy can be very hard to reverse. An economist, Kyle Handley, points out that the last time the world saw tariff escalations on this scale, it took about half a century for things to truly settle back into a more open trade environment. In other words, even if the United States regrets this move later, rolling back tariffs might be a project that takes multiple decades altogether. Now, the main public argument that Trump has put forward is that tariffs will actually push the American economy to rely less on imports and become more self-sufficient, especially in the fields of manufacturing. And the logic here is that if imports get too pricey, domestic factories might end up producing more and people might buy local products. But international trade is usually complicated. Foreign businesses usually find legal loopholes to bypass tariffs, sometimes by adjusting supply routes or swapping parts in one country for parts in another. Also, currency exchange rates can shift, which can soften or even cancel out some of the intended impact of tariffs. Now, inside the United States, businesses accustomed to global supply chains could find it very painful and expensive to reorganize their operations. Customers may end up paying higher prices since more taxes on imports generally push overall costs up. Trump has also claimed that the revenue from tariffs might be enough to remove the need for Americans to pay income taxes altogether. But experts believe that this is very unrealistic. Because while tariffs bring in some money for the government for sure, it is nowhere near as large as what comes from income taxes. And if other countries start matching these tariffs with tariffs of their own, American companies selling products overseas will start to face extra hurdles, which could eventually start hurting overall government revenue even more. But what seems more credible is that for the time being, the sheer size of America's market does give Trump powerful bargaining chips when he negotiates with other countries. Almost every nation wants access to American consumers who buy vast quantities of goods. And that is why America can use this to put pressure on countries to do what they want. But there is a question of whether this advantage justifies the broader costs such as damaging relationships with key allies and weakening the global trade system that has been built up over many decades. And if we look back at history, Trump's new policies seem a bit like a return to the era before the 1930s when the United States often put high tariffs on goods coming from abroad. This approach reached its peak with the Smoot-Hawley Tariff Act of 1930. That law dramatically increased tariffs on more than 20,000 products right as the world was sliding into the Great Depression. Soon after, dozens of other countries did the exact same thing to the United States, and international trade collapsed by around 60%. Smoot-Hawley was not the main cause of the Great Depression, but it did make the downturn last longer and become even more severe, especially because American exports dropped by half when other nations shut them out in retaliation. Some scholars even argue that the global tension that followed contributed to the outbreak of World War II. Now, in those days, imports were a very tiny share of America's economy, which is around 1.4 of the country's total output. But today, let me tell you, they stand at roughly 15%. And yet, if you compare them in scope, Trump's tariffs reach even further than the Smoot-Hawley measures did. After witnessing how harmful Smoot-Hawley was, the United States spent generations moving in the opposite directions. They lowered trade barriers, boosted global commerce, and helped build what people called the rules-based international order. Now, for your reference, this order rests on the idea that all nations should follow certain agreed upon rules so that no country can just throw up arbitrary barriers whenever it feels like. And over time, these values have led to institutions like the United Nations, the International Monetary Fund, and the World Bank, all of which were shaped or strongly influenced by the United States after the World War II. And even though these systems were not perfect, and at times they were used for political or strategic gains by powerful countries, they still created a world that was far more connected. As one economist, Doug Irwin, notes, countries started a pattern of mutual cooperation, each lowering trade barriers so that everybody could benefit from a steady rise in world commerce. From 1950 to 2023, global trade shot up by over 4,000%. This was thanks in large part to this environment of greater cooperation. World Trade Organization, or WTO, was the strongest example of that spirit. It took many years of negotiations for the United States, Europe, and over 100 other countries to create a body that could oversee trade disputes and also ensure that countries stuck to the rules that they agreed upon. The WTO's basic premise was that if a country felt that another member nation was breaking the rules, maybe by unfairly taxing imports or favoring local firms, it could bring a complaint to the WTO. If the WTO found any wrongdoing here, the offending country was supposed to change its policy immediately. And in practice, it often worked out because the WTO had real authority. If a country refused to obey, the United States or other major powers could punish it by restricting access to large markets. But the WTO had an important flaw. It required consensus among all its members before it could move on major changes. And since it has 166 members, it was always going to be a very difficult task. In the recent years, though, the WTO has faced deeper problems. Some of these problems are structural, and the others relate to countries like China, which many people say has sometimes bent the rules for their benefit. Another issue is that Trump actively weakened the WTO by blocking appointments to the group of judges who handle appeals here. And without these judges, there is no final say on a dispute. So if a WTO panel says that a country must fix a certain trade violation, that country can simply appeal and never even have its appeal heard in the first place. And as a result of that, the entire system has ground to a halt to some extent. And it's not just the United States that has played a role in damaging the WTO's authority. Many other countries, including the likes of India, have occasionally hindered negotiations as well. But once America stopped giving the WTO its backing, the institution ended up losing its main source of muscle. But now with Trump putting major tariffs on America's trading partners, it almost feels like the final stage of WTO's decline. The rules-based system that once used to constrain tariffs is no longer as effective as it used to be. It took around 90 years to get from the days of Smoot-Hawley to this more collaborative global environment, and now we may be undoing that progress altogether. The biggest loss is trust here. For decades, companies from different countries felt that they could rely on stable rules, making it worthwhile to invest in cross-border production and trade. But the problem is that when these rules suddenly start to crumble, businesses no longer feel certain that they will be safe from sudden policy swings or new barriers to trade. Research interestingly shows that unpredictability is far more damaging to trade than higher costs are. Now, the thing is, with enough warnings, companies can handle a certain level of taxes or fees. But if everything might change overnight, they would often prefer to keep their operations at home or at least invest less in global projects. Now, the results of this might not be obvious in good economic times when the demand is strong and businesses are ready to do what they can do in order to reach consumers, even if tariffs are a little bit higher. But the real damage could actually appear during an economic slowdown when businesses are already scared to spend money. And in these very moments, countries also become a lot more protective about their own industries. In the past, the rules based system of the WTO helped prevent too many countries from shutting each other out. And if that system is no longer functioning well, then in the next crisis, we could see an extreme wave of protectionism that could further weaken the global economy. But all that said and done, there might be a slight bright side to this. If America pulls back from its position as the world trade's leader, other countries or group of countries may decide that they want to fill that gap. China, for one, seems eager to present itself as a champion of multilateral cooperation, especially after the US walked away from some global deals like the Paris Climate Agreement. Other large and increasingly influential economies like India, Brazil, or Indonesia might also step up here. But of course, it's too early to know what this replacement might look like, but the simple truth is that most countries still want and need trade. They have powerful incentives to reach agreements that keep goods moving and markets open, even if those agreements no longer rely on United States leadership. So in short, these new tariffs from the United States and retaliations from countries like China are not merely short-term disputes. They are part of a larger drama that might mark the end of the post-World War II system in which the United States championed open trade and global rules. If the rules-based international order really is unraveling, then the way countries do business with each other may undergo a very, very big transformation. Of course, nobody knows how exactly this might evolve, but it is pretty safe to say that it could take years or even decades before the global trading system finds its next stable shape. That brings us to the end of the two stories of the day. With that, let's move on to the final segment of the day and talk about the quick news headlines. First, Nestle India is aiming for a 7,500 crore rupee revenue boost by focusing on premium products, which is a segment that has grown at a strong 16% CAGR since 2015. But the company is facing challenges due to sluggish urban consumption, which is driven by high food inflation and weak wage growth. Nestle is also counting on the 1 lakh crore rupee tax relief from Budget 2025 in order to stimulate demand, though a portion of this relief might actually end up going towards savings or debt repayment instead of spending. Second, Titan Company posted a 25.2% year-over-year revenue growth in quarter 3 of FY 2025, reaching 17,740 crore rupees thanks to strong festive demand. Its jewelry business saw a 26% jump in revenue to 14,697 crore rupees, but net profit remained flat at 1,047 crore rupees, down 0.6% year-over-year due to the impact of customs duty reductions. On a quarterly basis, net profit surged 48.7%. While revenue growth remains solid, margin pressures are evident despite a 22.1% quarter-on-quarter revenue increase. Third, Bhavish Agarwal's AI venture Krutim has announced a massive 2,000 crore rupee investment for 2024 with an even bigger 10,000 crore rupee planned for 2025, and this is one of the largest AI commitments in India. The company recently became India's first unicorn of 2024 after securing $50 million in funding. Krutim is basically developing advanced AI models focusing on 10 Indian languages alongside English to strengthen India's AI ecosystem. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.